Hello and welcome back to Intertax Learning. Today we'll be talking about FIRPTA, or the Foreign Investment in Real Property Tax Act. Not only will we go over the basics, I'll also be showing a complex example of the implication of FIRPTA, so stay tuned. To start, there are many acronyms in U.S. international tax, and it's easy to get lost. One simple trick I use is to focus on the RP inside FIRPTA. It reminds me that this regime is all about real property. FIRPTA is fundamentally a withholding regime triggered by a sales transaction. It applies when a foreign person disposes of a U.S. real property interest. To clarify, I wanted to distinguish a foreign person's tax obligations from that of a U.S. resident. A U.S. resident's sale of a real property is taxed as a capital gain, determined by the profit and how long the property was owned. The U.S. resident files a U.S. tax return which encloses all the details required to calculate the capital gain and its tax. However, a foreign person, or so-called non-resident alien, may not file a tax return if his or her U.S. property is not in connection with the U.S. business. For example, a non-resident alien invested in an apartment complex in the U.S. It sits there for years. During the real estate boom, the non-resident alien sold it for profit. This apartment complex has nothing to do with the U.S. business. The non-resident alien doesn't live or earn money from the U.S., so filing a U.S. tax return is not necessary. In this case, how does the IRS ensure tax collection on the sale? And that's where FIRPTA comes into the picture. FIRPTA ensures that the IRS collects some tax, although it may be possible that the withholding tax collected on the sale price is higher than the true tax on gain. And we'll talk about what to do when that happens. Next, let's talk about the withholding rates. First, let's make it clear that FIRPTA withholding is based on the sale price, not the gain. For properties over $1 million of sale price, the withholding rate is 15%. In some residential use case, or when sale price is equal to or under $1 million, the rate may be reduced to 10%, but the standard rate remains 15% for most transactions. Next, let's distinguish what counts as a U.S. real property interest. U.S. real property interests include land and buildings, including a personal residence, natural deposits like mines and wells, growing crops and timber, personal property associated with the use of real property, for example, mining equipment, farming machinery, or a hotel's furniture and fixtures, and importantly, any interest in a U.S. real property holding corporation or a U.S. RPHC. If the corporation was a U.S. RPHC at any time during the 5 years before the sale, a corporation is generally a U.S. real property holding corporation if half or more of its fair market value of its worldwide assets consist of U.S. real property interest. Let's walk through a simple example. A non-resident alien owns a commercial building in the U.S. and sells it to a U.S. real estate investor for $2 million. The amount realized, or the sale price, is $2 million. And the standard FIRPTA withholding rate is 15%. That means the buyer must withhold $300,000 and remit it to the IRS. Now let's look at a more complex example. In 2024, a condominium in New York was purchased for $1.5 million by Mr. T, a U.S. non-resident alien. In 2023, he sold the condominium for $1.8 million. Under FIRPTA, Mr. T is subject to withholding at 15% of the sales price, which is $270,000. Mr. T's U.S. tax liability on this transaction is considered fulfilled once the withholding tax is remitted by the buyer. However, if you look at his true tax on gain, Mr. T's actual gain is $300,000 without taking depreciation into consideration. Tax on his gain will be at most $111,000 using an individual tax rate of 37%. It's clear that the withholding tax of $270,000 exceed the estimated true U.S. tax liability. If Mr. T wants to recover the excess tax, he must file a U.S. tax return, in which case the tax return will calculate tax on his gain and reduce it by the withholding tax he paid on the sale. If Mr. T is indeed subject to the highest individual rate of 37%, his refund would be $89,000. But what if Mr. T needs the cash and wants to pay as little withholding as possible? Alternatively, Mr. T could have applied for FIRPTA withholding certificate by filing Form A288-B before the sale. This allows the IRS to authorize a reduced withholding amount based on the maximum tax actually due. Notice how this form asks you to fill out the contract price and the adjusted basis of the real property. This doesn't reduce the tax itself, but it avoids the need to wait for a refund. So seller's withholding tax is same as the true tax calculated on the capital gain. This requires more prep work, but less tax is paid out of pocket at the time of sale. Alright, that's it for this video. Today we talked about the basics of FIRPTA and its tax implications. In the next video, we'll be discussing a different acronym called FACTA, or the Foreign Account Tax Compliance Act. I hope you stay tuned for the next one. Thanks for watching Intertax Learning, where we make international tax simple, one concept at a time.